Around the world, energy is one of the most vital and important traded products for fueling the global economy. In the last week, it's no secret that the United States has taken a dramatically different approach to global trade. The president has stood up a set of tariffs starting at 10% and exceeding up to 50%, maybe even 100% on some countries. This has had dramatic impacts on markets. Businesses are trying to adapt. And we want to have a discussion today about what the implications of these tariffs are for the broadly conceived energy sector. Welcome to this program from CSIS. My name is Joseph Majkut. I'm the director of our Energy Security and Climate Change Program. I'm joined today by three experts, all affiliated with CSIS, who can help us understand the issues at play here from a variety of different perspectives. Going briefly around the table, my colleague Clay Seigle, Schlesinger Chair in Global Energy and Geopolitics, Leslie Abrahams, Deputy Director and Senior Fellow here in the Energy Security Program. Welcome, Leslie, to your first CSIS broadcast event. And a fan favorite and audience favorite, Kevin Book, Senior Advisor here at CSIS. Welcome all.
Thank you.
To be here.
Kevin, maybe we can start with you. You've written a lot from your Clearview perspective on what's happening. You attended the Senate Finance Committee hearing today with the trade representative. Can you give us a broad picture of where we stand and what the administration might be trying to achieve with these new policies?
Great to be here, Joseph. Clarification, I watched online. I did not attend in person.
Everyone who's watching us online is a welcome attendee
They're
of this
attending
event.
as well,
Yes,
I suppose. So what we see here is something between a short-term negotiating tool and a long-term restructuring of the global economic order. Today, for example, during the hearing, U.S. Trade Representative Jamieson Greer was essentially speaking to both. He didn't choose a side, but named both of them as objectives. Revenue generated by tariffs that bring jobs home, reshoring, reshuffling the economic landscape here in the United States, and rebalancing trade with U.S. trade partners. So the objectives as they've been laid out have been also triggered by emergency authorities the president has invoked under the 1977 International Emergency Economic Powers Act, for the first time being used in this fashion in its nearly 5-decade history, to impose tariffs. A lot of innovative new tariff technologies come out, of course, not just in sort of the demand quashing potential trade war risks that I think we'll be talking about a lot, but also the introduction over the course of the last month of secondary tariffs, using tariffs as a secondary sanction penalty to try to discourage oil relationships with Venezuela and potentially Russia. So what we're seeing is a really muscular economic force projection, a set of tools, a suite of tools being innovated and deployed in unprecedented fashion, and really in almost for a century unprecedented scale, and for objectives that are diverse, all of which have consequences, as I suspect we'll discuss, for oil markets and energy investment.
Why don't we start with oil markets? Clay, you're a keen observer of the industry. The president has an energy dominance agenda. The point was to really leverage U.S. supply for global geopolitical benefit. Now this tariff seem like they've caused potentially a lot of disruption for U.S. producers and a lot of nervousness in the market. What's the status of things?
Thanks, Joseph. I would say that the oil and gas industry is justifiably concerned with the most recent developments, particularly as they pertain to demand. And we've had a quite abrupt and sudden change in the economic outlook, whereas everyone just honestly, like substantially 10 days ago, was expecting, modest but steady positive growth in the United States. And now we've just had this sudden change in velocity to where many of the economists, many of the bulge bracket investment banks are now guiding toward a much higher probability of recession. If it's not the technical textbook definition of recession, certainly an economic slowdown that had not heretofore been anticipated. That obviously has huge ramifications for oil and gas, which demand for which generally corresponds with overall GDP and the economic trajectory. So you would expect with an economic slowdown, demand for oil and gas to slow. Therefore, it's no surprise to see markets really moving down in quite a precipitous fashion. I think we're off something like 15% in both crude oil and natural gas. That's $10 a barrel for Brent and WTI crude, approximately. So the market is really concerned about demand. I think that we need to see, I think, to Kevin's point about how temporary or permanent some of these measures are grounded in real policy decisions and are challenged potentially either in Congress or in the courts. And that'll give us an indicator about whether or not we're really in for a substantial downturn.
At the same time that we saw the tariffs announced last week, we also saw OPEC Plus accelerate bringing more barrels into the marketplace. These two things happened at the same time. I don't think they were planned to happen at the same time, but obviously they had a pretty big effect on oil prices. What do you see as, if Kevin's right that these new tariffs are going to be here for some time, the administration is going to give them time to work, whether that's via negotiation or to reorganize trade. How do you think the OPEC Plus group might look at the potential economic impacts? Are we going to see some changes there?
Well, all oil producers and gas producers have to be concerned at the prospect of a significant economic downturn. I mean, we have a relatively recent case study, and I don't want to scare the people in the audience, but it was just a few years ago. We had a pandemic shutdown that amounted to something initially like a 10%, haircut on demand. And I'm not saying that this is the same order of magnitude, but it is an abrupt change that corporate decision makers and policymakers are going to need to get their heads around. Now, when it comes to OPEC Plus, they had for many months, substantially more than a year, been planning to very gradually and in small numbers of barrels hike supply. And they initiated that program about a month ago. The market was expecting something like a third of what was announced the other day to hit effective in May. So that part is a double whammy for oil and gas companies that are worried about the future of demand in light of this global trade war and its ramifications on the macroeconomy, and then also more supply than had been expected. It's actually a triple whammy because one of the most important elements for oil and gas about the tariff program is the tariffs on steel.
Yeah.
And this is front and center for oil and gas and infrastructure. And so if those guys are going to have lower demand for their product and additional competing supply on the marketplace and a higher production cost profile, it's actually a triple whammy.
I'd like to come back to the input cost thing in a second, but let's dwell on the price issue for a minute. Kevin, the president came in wanting to reduce energy prices. I'm not sure that this is the way that we exactly wanted to do it, but where do you think that things stand today?
Well, if you're trying to lose weight, you can do it by working out or you can do it by starving. And if you're looking to see a lower price deck, you can do it on the demand side through starvation,
right,
or you can do it through production and efficiency, deregulation, tax cuts, those sorts of things. This is a number that is lower, and if you look at what that magnitude means, there's a couple of things I think I would add to what Clay said. First, more coffee house than trading house math, but if you work backwards from at least our assumed elasticity, and you ask what is the $12 of downward travel from the recent peak in Brent translate to, it's about 1.3 million barrels per day of supply flux or market flux. And if you take out the 400,000 barrels per day of OPEC adds, of which 300 some thousand were unexpected, you've got 800 to 900,000 barrels per day of sort of implied demand contraction. Now that, again, more coffee house than trading house, not fly to the moon math.
Right.
But I think that the other side of that, too, is that if you look back, Clay turns to the last crisis, as I think we all do, because informed not just by sort of the dynamism of that crisis, but also all the things we learned about the shale patch. One of the things we've seen over the last 4 price reversals in WTI, so moving from Brent to a different marker, is that you've actually had somewhere between 10 and 29 weeks before the drilling activity starts to sustainably slow down.
Right.
And then on the flip side of that, one of the things we've seen since sort of comparing the recovery in COVID to the recovery from the 2014 through 2016 troughs, going trough to peak on rig counts, the rig responsiveness to price was about 1/3 as much, about 30% in the 22 recovery as it was from the 2016 recovery in the oil patch. Now, some of that's efficiency, which is good.
Right.
Again, the working out part. But some of that's capital discipline and suggests that you can see some very different dynamics in the oil patch if you see that kind of reversal based on trade headwinds.
And what the practical implications of that for the ability to rebuild supply, after should we get an economic reorganization or demand again picks up, is that things fall apart much faster than you put them together. Is that the implication?
It's not a one-way ratchet, but it's a lot harder to run uphill than it is to run downhill.
Got it. And for on the consumer side of things, reduced prices obviously are going to be good. Politicians like it when they see reduced prices, and that can be good for other economic activity. So are we looking at a silver lining here amidst this broader economic reorganization?
Well, for me, I'm afraid not. Literally, I'm afraid not, because this oil price downturn, which of course has some advantages for consumers if you take it at face value, was caused by changes in the economic outlook. And so the idea is that people are anticipating a lot less spending by businesses, by consumers, and thus consumption of, let's say, petroleum products. So because that's the catalyst, we're already kind of baking in an assumption of an economic downturn.
Right.
I got to be pessimistic there.
Okay, that's fine. Leslie, maybe we can turn to you. We just published a big report here at CSIS on the AI needs, on the energetic needs of AI, right? And so much of the economic frontier, so many of the government's priorities for the U.S., whether it's reshoring manufacturing or staying at the lead in artificial intelligence, rely on electricity. And a lot of the electricity supply chain is now going to be subject to really significant tariffs coming through East Asia, whether that's solar panels, transformers, inverters. How should folks be thinking about the effect of these tariffs on input costs in the electricity sector?
Mm-hmm. Yeah, that's right. We have been fortunate to have declining costs in clean energy, and that's largely been due to this global network of research facilities, factories, supply chains that we've established. Mm-hmm. So these tariffs are really going to impact the prices of these technologies because the U.S. Has been greatly relying on imports, and not just imports of the final goods, but even the manufacturing that we do in the United States relies on imported components. And so as we see the cost of these increasing, we're going to see implications for the broader electricity system, impacts on ratepayers. And I think it's important to think about not just the clean energy technologies themselves, but we need to increase our grid size, both for reliability and for resilience, and to meet this growing electricity demand that we're going to have. And so, as you said, there are all these components that we're going to need to do that infrastructure build out, including the inverters and transformers. So it's going to have a really big impact on the overall energy system, not just the clean electricity components.
And so over the last few years, much of the effort of the USG has been reshoring a lot of that manufacturing supply chain, right? Recognizing its role in the political economy of decarbonization, but also in our own economic security. Is this new approach to trade, relatively high barriers, going to help in that process long term? Do we have a good sense of that?
Yeah, so since about 2022, when the Inflation Reduction Act passed, and new incentives came into play for domestic manufacturing, we saw about $200 billion in private investment in new manufacturing. But even since January, we've seen a decline in this. I think since the beginning of the year, a few kind of key projects, some battery manufacturing plants have already canceled. We've seen delays. And in January, there were about $100 billion announced in new clean energy manufacturing domestically. And typically in a month, we'd see closer to the scale of a few hundred billion. So we're seeing a decline in the pace of domestic capacity. Now, at the same time, there's uncertainty in how long these tariffs are going to last. So even if it's going to be days, weeks, or even a few years until a new administration, there's not certainty that it makes sense to invest in building all of this infrastructure for new factories in the United States. We also have to remember that construction costs were included in these tariffs. So being able to get the equipment you need for a factory, cement, steel and aluminum were exempt from these tariffs, but were previously tariffed. So all of that is going to increase construction costs. At the same time, some of these global, broader economic implications might make it difficult to get access to inexpensive capital to build. And then compounded with that is the fact that there's uncertainty in domestic incentives for the manufacturing. We will find out maybe next week or in a few weeks what's going to happen with the IRA tax credits. But if we take away demand or incentives for domestic manufacturing, as well as the incentives for buying domestically, like we are seeing with some of these electric vehicle tax credits that come if you buy cars built in the United States. Losing those domestic incentives paired with the tariffs are going to make it really difficult for us to see new manufacturing come to the United States.
So one of the goods exempt from these new tariffs is energy. And I think that represents an understanding on the part of the administration that energy is good for economic productivity, and that energy is a really good way to introduce tariffing energy would be a good way to introduce price shocks. But we heard from Kevin earlier that the use of tariffs on secondary tariffs and other things might be in the cards. So is that a durable exclusion for those at the table, or do we think that tariffs will continue to be used to extract political concessions or what have you?
Well, that's one of two outstanding uncertainties that I'm thinking of in terms of implications for the oil and gas segment is will the proposed tariffs on imported energy, will they remain exempt, or are they subject to, as a trade war escalates, maybe levering up in that department? Another really interesting one to consider is the retaliation steps that certain trading partners are probably going to take against the United States. We still have, I think, as of this hour, outstanding from the European Union and others as well. And the question there becomes, could energy be affected by retaliatory tariffs by trading partners?
Right.
These are two big outstanding ones that I think are important for the direction that the segment goes.
Kevin, your thoughts on this front?
Well, I think with reference to the exemptions for the new reciprocal tariffs, because we have many tariffs now, we have a layer cake of tariffs, and it's important to keep in mind that they have different sets of terms. Annex 2 for those reciprocal tariffs included a long list of exemptions. Most of Harmonized Tariff Schedule Chapter 27, mineral fuels, and yet it did not include biofuels, which is in Chapter 22, if you're keeping track at home, nor did it include solar or wind components.
Right.
And so there were certain types of energy that were not exempted, even in the broad exemption that we saw in those reciprocal tariffs. And so there's that aspect of it. And then there's, of course, the Canada. I mean, so much of the energy that we're talking about is Canadian crude and also electricity. And there's unanswered questions, to the best of our knowledge, still unanswered questions regarding the treatment of Canadian electricity. There are three possibilities: 0%, 10% because it's treated as energy, which technically doesn't comport with the plain text of the order on the Northern Border Emergency, which uses the national energy emergency definition of energy, which is not electricity inclusive. And then there's the possibility that it could be a full 25% because of that. So is it in energy? Is it not in energy? These sorts of uncertainties are challenging. Add to that the retaliation that Clay mentioned, which is, I think, a non-trivial thing. Canadian sentiment has changed a little bit. They're apparently not coming to visit New Hampshire, according to Senator Hassan this morning, as much as once they did. And Doug Ford, the Premier of Ontario, has threatened and then retracted a 25% export tax on electricity to the United States, which, limited in its sort of geographic nexus, is also yet another part of this broader equation. And just to get down to the secondary tariffs, I feel like we should talk a little bit about this. The idea of secondary tariffs against Venezuela means that the buyers of Venezuelan oil would face tariffs selling anything they sold to the United States. it doesn't necessarily mean that there would be tariffs on oil from Venezuela, which, as of the rescission of the general license 41 for Chevron and the specific licenses for the other producers, presumably would not be allowed for import in any case.
Right.
But it does look like a very powerful tool. And it does seem to have stopping power in ways that maybe disconnection from the banking system has started to lose. The primary sanctions, of course, blocking immediate purchase, were reinforced by secondary sanctions, cutting buyers of the product that we wanted to target off from the U.S. banking system. But what if they weren't attached to the U.S. banking system? Well, then they had no potency. Well, now we're talking about cutting off the entire economy with these secondary tariffs. And if the Venezuelan barrels could find another home somehow, through swaps and logistical shuffling,
Yes.
Russian barrels, that's a very, very big volume to realign anytime soon. So the mention the president made several weeks ago of potentially using that same approach, secondary tariffs to Russian barrels, could have some significant supply side impacts. We're mostly talking about the demand side impacts of tariffs, but that could be upside risk to price if those barrels get stranded somehow because Ukraine negotiations break down.
Not to throw another chit onto the table, but we're also resuming nuclear negotiations with Iran. I believe on Saturday is the announcement.
Directly or indirectly?
Unsure at this point, but the idea that we have a lot of potential supply side disruptions to upside or downside seems to be just we're in a moment of great upheaval.
I think that's fair, and there's even a potential for whiplash here in the energy commodity markets and crude in particular. I mean, right now, all of the focus, to restate the obvious, has been to the downside. And I think that it's very justifiable to have a base case that's bearish right now. On the other hand, the Trump administration was very clear in, I think, NSPM 2 from February, which laid out its policy toward Iran, that it's unacceptable for Iran to have a nuclear weapon and to continue to finance terrorism through proxies, which we can interpret here as meaning the Houthi attacks that are emanating from Yemen, and that we have been in a kinetic, active combat against for the last few weeks. Where I'm going with this is there is, so this is a big fork in the road. It could go either way. President Trump has said that he definitely favors a deal, and at the same time that if there isn't a deal, things could go really bad for Tehran. And so if we believe that between very thinly veiled dialogue like that and very obvious and heavy footprint military moves into the Middle East, CENTCOM, theater of operations, alongside some of the diplomatic moves and coordination that's been taking place in open sight, it seems like a military option is certainly on the table. And so I'm just raising the prospect for a potential whiplash in crude prices should push come to shove with kinetic action against Iran. You certainly have a bit more than 1 million barrels a day in Iranian crude exports that are on the table. OPEC Plus, with its significant spare capacity, can cover anything of that magnitude. It's the Iranian response to being attacked that I think represents the real upside and bull case here. And Iran has, for a long time, kind of held the position, hey, if we can't safely export our oil, other folks should be concerned about theirs. So
Right.
let's leave it there, right?
Clay, I think you texted me that J.D. Vance, in his Signal chat, which we all have now read, raised that consequence, that Iranian response that if they can't export, others will be impaired. And that risk, I think, is widely understood from September 14th, 2019.
Completely. And if
previous crises.
There seems to be, and I'm not an oil markets expert, but it seems to me there's asymmetry. You can see the price drop a lot when 800,000 barrels a day of demand goes away. But disrupting 800,000 barrels a day of supply could happen for a lot of different reasons: secondary tariffs, conflict, export controls, what have you. And it seems like there's just a potential period of great volatility here. Is that roughly correct?
I think it's a full analyst employment policy, if that's what you're asking.
For all of our friends in the audience who are not as oily nerdy as Kevin and I, that reference to September in 2019 was about the Abqaiq attack, which took down probably the biggest oil processing asset in Saudi Arabia and in the Aramco system for a short period of time. But it does sort of represent a signpost and a milestone in terms of geopolitical risk in the region.
I want to talk a little bit about this new trade agenda and its implications for the energy dominance agenda. So Clay, you mentioned earlier the fact that imports on steel, aluminum, and other sort of industrial goods, which are an input to oil field development or oil development, could provide a drag for the industry. But is drill baby drill still possible in today's environment of increasing costs on the input side and falling costs in the market? Falling prices in the market, excuse me.
Well, the short answer is it's looking less and less likely from the tape this week and in the last couple of weeks. But drill baby drill, first of all, is primarily a political slogan.
Sure.
It's not exactly an upstream or E&P business strategy. And it was always kind of in conflict with President Trump's very early aspirations for reducing oil prices significantly down toward $50 a barrel. Those two things don't go together. We will always have an element of drill baby drill in the U.S. oil patch because we need constant drilling just to replace reserves that deplete rapidly in shale and tight oil formations. But I think to the essence of your question, you can't bring oil prices materially lower and also have an increase anywhere near the 3 million barrels a day. And to be fair, that was barrels of oil equivalent. There could be other contributors to that formula that the Treasury Secretary has raised. But you're not going to get anything like that. In fact, you're going to see rigs laying down and E&P companies kind of circling the wagons and being more conservative. Because again, you have very acute concerns about the future of demand. You have more supply coming on stream. And to your point, additional costs from this trade war and tariff program. What is a responsible E&P company supposed to do? And don't forget that there's also this era of capital discipline and enforcement that Kevin raised before. Investors don't care about energy dominance; they care about energy dividends. And so those are the marching orders that that OPCO operating company management teams are instructed to deliver for their stakeholders, and justifiably so. So those things were kind of always in conflict, and this is just sort of leading us to a precipice where these companies are going to have to change their spending plans pretty soon.
Well, and then we have the question of how are other countries going to respond, right? A big part of the energy dominance agenda is leaning into exports. And I think the president and a lot of other people see a lot of economic value in the U.S. being a big energy exporter. But for example, we haven't shipped an LNG cargo to China since early February in response to the first round of tariffs launched by the administration. You mentioned the EU, Clay, right? 40-some% of U.S. LNG exports go to the EU. We don't know what their response yet is going to be, either immediately or over the long term. Kevin, maybe you have some thoughts on this question of kind of how do global markets respond, and what does the U.S. look like as a kind of easy to work with trading partner?
Well, the dominance question is not as straightforward, I think, as just talking about demand, because there are market opportunities. One of the things that has come up over and over again since the start of the Trump administration, second Trump administration, is the notion of rebalancing trade with LNG purchases.
Yeah.
And that has become extremely acute in the last week. So now you have mentions in almost every conversation.
Every leader is coming to Washington wanting to buy LNG.
There's a lot of sale and purchase agreements that could be signed pretty soon and get us to some final investment decisions if that's where we're going.
Right.
And so to the extent that LNG has become the coin of the realm, and it makes some sense, right? If you have an energy short trade partner, they're going to have to buy LNG anyway. This gives them a chance to whittle their surplus while satisfying their demand at home, but they were going to need to satisfy anyway. So that, I think, is part of the dominance agenda is to produce, and part of it is to export. And I would argue that dominance 2.0 has a zero-sum component, and in a flattish market or a flattening market, particularly one that's flattened by trade war, trying to sort of defend or gain market share on behalf of the U.S. seems like a component of that too. This would be a way to do that. Now, that is a very gas-centric way of looking at the overall equation. You're very right, Joseph, to mention this. So 2018 and 2019, we had a trade war with China before. And tariffs went into place. There were a series of steel tariffs initially in March of 2018, followed by Chinese reprisals initially against U.S. ethanol, which with tariff rates, by the way, on a stacked basis got to 70% and above as part of that action. but eventually led to a 25% tariff on LNG imports. And guess what? It went to zero. Crude went to zero. And crude was a smaller part of the import mix in China than U.S. LNG was. But Beijing showed its displeasure very tangibly, and the market economics took whatever part of it wasn't displeasure.
Yeah.
And the message was very clear. The thing is that crude is intrinsically more fungible than LNG. And so if you're trying to sell sale and purchase agreements, or you're trying to write sale and purchase agreements, one of the good things to have available is a very large and growing market.
Yep.
And losing one of those large and growing markets makes things a little bit harder. So the coin of the realm being LNG is good, but having a smaller realm is bad. And then, of course, the demand headwinds make signing some of those agreements also more difficult. You'll see less enthusiasm about 20-year tenors or 15-year tenors when you see demand cratering.
Yeah, I mean, in places where the state has a bigger role in the economy, I think we are seeing, whether it's in India, Vietnam, Japan, real efforts to reach out to the U.S. administration and say, hey, we're going to buy fossil products, right?
For sure.
And whether or not, I mean, if you do a little bit of napkin math, you find that it's hard to cover some of these trade deficits with LNG trade, but certainly it appeals to the administration's priorities along like a number of vectors, and they like LNG exports.
You want to be a historian for a few minutes?
Yes, please.
So there's a precedent set by a president named Trump in this regard, with the previous European Commission president, Jean-Claude Juncker, former President Jean-Claude Juncker, who signed what was called a 3 zeros bargain. Zero tariffs, zero non-tariff barriers, and zero something else, which I've since forgotten. It's apparently zero in my recollection. But part of what it involved was an agreement, sort of a handshake agreement to buy more LNG. That actually sounds a little bit like the template for where we are now. So there's a certain consistency, I think, in the formula. But in this case, I think that the rubber might really hit the road.
Right. Please.
So as I hear Kevin describe the situation, especially before with regard to European purchases of U.S. LNG, the question I'm asking, if I put myself in the head of those decision makers over there, I have to be concerned about, and sorry if this is provocative, but almost the rise of a new element of political risk in the United States, because we have seen these swings along the continuum, these swings of these pendulums in terms of from one administration to the next. We have really different views on what we want to accomplish with natural gas and LNG in particular. So can those European buyers, even though there might be a transaction frenzy taking place in Washington these days, and folks lining up because there's short-term interest, what should they think about in terms of 4 years out, 8 years out, et cetera, with regard to the United States being a long-term, reliable supplier of LNG? And so I think we know where we are from the industry perspective. It's about the political and the policy frameworks that those buyers are going to have to deal with. And there's another elephant in the room there for those European gas buyers and those that have to fill storage tanks there on a routine basis, which is, how does this hot war in Europe end? And to what extent may Russia become an important supplier again to the continent, even though it will probably never claw back what it had before?
Yeah, I was just in Europe last week, and I've been there a couple times over the past month, and there is a rising sense of concern about, is the U.S. a trusted trade partner with respect to LNG? I mean, it started with the Biden administration and the pause, and now the sort of the fervor of trade impositions under the current administration is causing nervousness. Though you have to look at the volumes and say that there should be some confidence there, right? The U.S. has a lot of LNG to offer. There's a lot more coming online, and until there is a national emergency declaration on gas, we have open permitting for exports, right? There's just a lot of approved facilities. Leslie, can I turn to you again and think about the response on the part of exporters of electricity infrastructure, clean energy goods? A large degree of investment into the electricity sector every year goes toward imported products. What are the indirect effects on commercialization of clean energy technology and innovation we should look toward as we enter this new time?
Yeah, I think that's an important question because we can talk about the direct cost implications on the tariffs for clean energy, but I think there are broader implications that we need to think about. So for one, something I think is really important is U.S. innovation and U.S. innovation leadership. And one thing I'm concerned about is with some of these uncertainties around clean energy deployment and the kind of posture of the administration around supporting fossil fuels and uncertainty around what's going to happen with the tax credits, as well as the global economic implications of the tariffs, that there will be less investment in both R&D and our early stage kind of venture capital, especially the new technologies that are trying to go from kind of bench scale to deployment. I think we have a potential to lose a lot of momentum in our innovation space, which, as we're thinking about some of the long-term implications, this will be really important for our global leadership in commercialization. And when we think about how much infrastructure and technology is going to be deployed globally, this will mean that we're going to be really ceding some of our potential market share abroad.
Right.
So I think the innovation space is one indirect implication that we should be thinking about. And similarly, if we're thinking about the U.S. reducing imports from certain countries like China because of the tariffs, those countries that have manufacturing capacity of clean energy need to send that somewhere. And so they're going to be looking to kind of the low and middle income countries to take some of that, some of those products where there hasn't been as much uptake in clean energy. And so on one hand, this helps kind of accelerate adoption in those countries, which is good for emissions. But what that means for the US is that that's also some future market share that we're ceding there.
Right. If you take the long-term view and you look at the folks who are advising the administration, the idea of these tariffs is to, one, help drive reshoring and manufacturing, but also to create a new trading system. And I don't think we fully understand what the contours of that new trading system should be, but part of what you hear is balanced trade aligned with security relationships and a smaller set of partners, right? A sort of ex-China sort of trading arrangement. Now, from the climate world, we talk about these kinds of arrangements all the time when we think about carbon border adjustments and climate clubs. What is, Kevin, I'd love your thoughts on, where, even if it is quite unclear today, it does feel like the world is moving toward plurilateral as opposed to large multilateral arrangements. And what does that really mean for energy?
Well, so, we have two presidents in a row, or I guess one president and then another president and then the same president in a row,
right?
Who've essentially said that
unlikely that we'll do the fourth one, though. I think
just probably
given age issues.
Well, separate topic. But I think that if you look at the move from economic optimization through globally sourced, just-in-time supply chains, to economic resilience, which I think is sort of how I would describe the common threads of the two administrations, through just-in-case domestic production. They're very different worlds. When you looked at global sourcing, you were doing was minimizing the working capital tied up in your production.
Yep.
And that created just a lot of economic opportunity and it attracted a lot of investment into a lot of sectors. When you start to have, first of all, the frictional costs of potentially higher labor and environmental restrictions operating in some of the alternative places, but also some of the dynamics that play out over time. Like, think about what it means for overall energy demand. Like, if you bring a lot of stuff home, the other stuff's still there, and so now you have new construction energy demand, you have new operating energy demand, you have essentially a bump, maybe a spurious one though, because now if all this capacity in the world, especially the world's growing slower because of the frictional headwinds that come from trade tensions, if not war, then you probably are below trend on growth and below trend on energy demand. And now you have these more expensive things that you've built that have sort of less runway ahead of them in terms of addressable market opportunity. That doesn't sound so good. And so, it's a very complicated thing to try to do. Now, in terms of the overall parameters of changing, is the dollar still the reserve currency? I think, for the near term, we assume the answer is yes. Mm-hmm. We get a lot of interesting oil market questions when that changes.
We're going to have a whole separate conversation about what the devaluation of the dollar means for global energy markets.
Okay. I will look forward to that with great interest, because I think there's a lot of answers to that question that do directly impinge directly on all your price forecasts. If you just think about sort of the nature of unlocking demand with a weaker dollar, what does that mean when you're not as dollar denominated? Wow, separate session, separate topic. But also just the idea of creating sort of these clubs, these clusters of zero tariff zones, particularly if the zones are not defined by economic advantage, but rather by ideology. This was already happening in the Biden administration, right? They were looking at like-minded friends that we were going to source from. Right, and if you go back to August or July of 2020, sort of ironically, at I think the Reagan Library or the Nixon Library, it was the Nixon Library, Secretary Pompeo describes sort of rebuilding the global order into a like-minded friends kind of order as well. This thinking's been around for a while, but like-minded isn't necessarily the most economically efficient, right? So if we're picking our ideological simpatico peers, we may be getting different economic results from an energy investment and yield perspective than we would have gotten if we were still thinking primarily about other parameters.
Look at Southeast Asia as a great example, right? So much of the supply shift, the rerouting that occurred post-COVID out of China now runs through Southeast Asia. That's one of the places that leads to a huge trade deficit with the United States, and now very large reciprocal tariffs. That's also one of the places where we expect energy demand to grow over the next 2 decades. And so there's immediately some tension between we're going to seek balanced trade with partners, and the U.S. wants to be a big player in meeting this new global demand. You can't even think about global demand. It's like, where does the demand amongst your friends going to be? And that's a very different set of questions for energy strategists, for firms, and for governments.
It's in a world of free trade, including energy commodities. Yeah, fair point.
Well, very much to figure out. I want to thank you all for joining me to help unpack some of the implications of this new regime we find ourselves in. I don't think personally that it's going to go away. I think we're going to be navigating this for some time. So I look forward to reconvening the group in the near to distant future for further discussion.
Thanks for having us.
Thanks.
Colleagues joining us online, thank you so much for your kind attention today. Do follow our work here at CSIS, where you can hear insights and read insights from our colleagues on these and other issues. This is Joseph Majkut signing off.